Well, hello everyone, and welcome to this video blog. Today we're going to talk about something that may be near and dear to your heart, especially if you're a bondholder, and that is what happens to bonds in a rising rate environment. We never know, that we are going to see some interest rates hikes this year that have been anticipated due to inflation creeping back in. And I'm joined by Eric Stein from East Bay Investment Solutions. So, Eric, thanks for joining us.
Thanks, Brian.
I'm going to let you take over and maybe fire away a couple questions at you.
Sure. I'm actually going to skip to this slide here just to kind of talk about bonds in a rising rate environment. And what's important is interest rates and bond prices move in the opposite direction. So if you have interest rates going up, you have bond prices going down, and that also works in the reverse. So any kind of bond conversation you have, it's just always important to remember this conversation. This conversation kind of drives everything as it relates to bonds. And what this chart is telling us, this actually looks at 10-year treasury yields going back to 1958 through the middle of February 2022. So it's actually got a pretty long-term time period here. And what's interesting is, again, if we think about that relationship of bond yields and bond prices, if you think about 1981, we're talking about interest rates at over 15%. We haven't seen, obviously, that since. It's pretty significantly higher than where we are today. Right now we're just over 2%, so a pretty big change. So what we've seen in bond returns over that time period from 1981 through 2022, again, if you think about this, while it's not a straight line, yields have come down pretty dramatically. That means bond prices have also gone up over that time period because of that inverse relationship. So that's something really important to see. So if you think about, again, yields between 1958 and 2022, they've been just below 6% over time. Today, they're just over 2%. Pretty significant difference. Unfortunately, if we were starting to see bonds go from 2% up to 16% again, you would again see that inverse relationship where prices would come down. We're not expecting to see bond prices up at 16% anytime soon, or bond yields, I should say. But again, that inverse relationship is pretty consistent.
So, but even if this graph does a little bit of that number, I've heard people talk about we're in a bond bubble of all bond bubbles, meaning, and I'm not trying to predict that. I certainly don't have that crystal ball. But if people are always talking about bubbles, we've been in a 40-year bull market with bonds.
Correct.
And mostly, and you can really simplify it, this line really tells the story, right? So to think about it for our folks watching, is this line's gone down, the prices have done the exact inverse of that, right?
Correct.
And while we're not anticipating the replica of that or the other side of it, you're probably going to get something there on the other side. Hopefully, it's tampered or measured, but that would be the concern, right?
That would be the concern. Obviously, that would be part of it. But again, if you're a saver and you've been at a bank and having a CD or a money market fund, you've been earning nothing
Right.
for the last several years because interest rates are near zero. So if we start to see short-term interest rates in particular start to creep up, as a saver, you'll start earning more on your bonds. The other thing with sort of bond funds is bonds are constantly maturing. So if you have a bond that had a low yield that is maturing and yields go up and you reinvest that money, you'll start reinvesting in bonds that have a higher yield. So that relationship, again, you'll start to be able to get a higher coupon, a higher yield from those bonds over time as time goes on.
And likewise, and I always tell people, if you happen to own individual bonds, even though for most people probably not the best decision, but if you did and you held it to maturity and it was a quality bond, it may not matter to you with volatility. You'll get prices in between, but you'll ultimately mature for whatever you should mature for.
Yeah, and what's also interesting about this is sort of the relationship between nominal yields and inflation. So if you think about nominal yields minus inflation gives you your real yield. Again, inflation from 1958 through year to date 2022 has been a little over 3.5%. Right now, it's over 6%. So if you look at that difference, if you think about your nominal yield being 2% and you subtract out 6%, you're at minus 4%. So your real yield, what you're actually earning after inflation, is significantly lower than it was when inflation was much lower as well. So you want to watch that differential between real yields and nominal yields.
So even if we stay flat right now, you're just losing money, say.
Correct. Yeah, if you're with inflation where it is, you're going to be losing from an inflationary perspective.
Right, and that would be a different presentation we worked on, but we won't get into that. So that's on the equity side of what you do during inflationary times, right? And that would be how you maybe combat some of that stuff.
Yeah.
But we do own bonds and portfolios for those retirees and more conservative portfolios, because if some catastrophic geopolitical event happened, there could be a flight out of equities at that point in time, whether it be short or midterm. And certainly bonds historically have helped buffer some of those downturns.
That's absolutely correct. If you're in high quality investment grade bonds, in particular treasuries, they're going to be a good buffer for equities in terms of downward markets in equities. And then even corporate bonds, again, high quality corporate bonds should give you a higher yield, more risk than a treasury yield, should give you a little more yield than a treasury, but still be high quality, going to be less volatility than a traditional equity as well.
Awesome. Well, that's helpful for me. And so one of the things I've taken from this, and I'll just ask, as we leave the audience here, I think the key is make sure you got a plan, as always, but your portfolio can combat inflation. And if we're in a rising rate environment, the type bonds you own and what you own, that it matches all of that, right? And that you have an advisor that's helping you along with that.
Absolutely. You want to make sure your plan and your portfolio are matched together.
Yep. Awesome. Well, thanks so much for joining us and providing that information. I hope you all enjoyed it. If you have any questions about bonds and rising rates, please give me a call. Until I see you next time, take care.